Hello, YouTube. Welcome back. Today we're going to be talking about the trap and who is going to win this trap because honestly, I'm a little bit confused. I'm confused because we've now had 9 out of the last 10 weeks which have been down. So if this is a trap, is it the Bulls or the Bears who are going to get stuck? That's what I really don't know and what my goal for this weekend is. We have some really important data coming out next week, including the FOMC meeting, and we got OPEC. So this is going to be a very spicy week. And I think we have an excellent video prepared for you. So let's jump straight in. And if you're enjoying the video at any time, I would appreciate a thumbs up. And make sure to drop me a comment and subscribe to the channel if you haven't already. Thank you very much for getting us to 5,000 subscribers. All right, so the reason why I have these 2 boxes circled here is because, again, 9 out of 10 weeks is like pretty devastating. And it kind of seems really easy jumping onto the bear side now. And when we look to the screenshot here from Bloomberg, it tells us that again, 3-day fade sends index to worst week since January. And we can also note that we have the indexes synchronized or moving together. So this seems like it is a, synchronized or coordinated move. We note that 2 weeks ago we had all the major ETFs moving higher, and now we got them right back down to red, all synchronized. So again, we're noting here that we have the worst week going back to January. So what I'm trying to do is to go back in time and try to figure out, well, what exactly happened in January? Because the biggest weekly decline that we have is going to be right here. Now we can know the candle that we have right now. It's a big red one. Yep, it's a big red one. So what's really interesting about here is just that, first of all, there's the pattern how we got to here, but then just the actual pattern that we formed. So what I want to look at next year is just going to be, again, we did have those 9 out of 10 red weeks, so it kind of seems easy to jump onto the bear side now. And there was tons of bad news this week, notably on Thursday, Friday. The ECB ended the era of not having interest. So now they're going to be doing liftoff. And we also heard the Bank of Canada saying that maybe they're going to have to go more aggressive. So maybe that's a preview for what we're going to hear from the Fed, which is kind of what I was concerned about last weekend when we made that commentary. All right, so now let's look at the chart and just see what's going on here. So we note that we have what I'm looking at here is going to be a couple of candles. I'm looking at notably these ones right here. So I'm looking at the big green week to when we actually fully puke it up. And first thing I just want to note is that we've not actually lost the range of the pump here. So we note that the pump, the low here is 386.96. That's going to be a very important area, roughly 387. Over here, back to January, once we lost that area, oh man, did we waterfall. So there's a lot more for us to go through. But again, just noting that we put in the big pump, we push to a new high, and then we stall out, put in a doji, and then we come down. So pretty much like just deleting this 1 week right here. We got our big up week, which goes back to here. So again, big up week right here. We got our big up week right there. We have a higher high, but undecided. A higher high, but undecided. And then what do we have? Well, we got our doji, which means indecision. And then we get our bear break. So here we got our bear break. So what I'm kind of looking at is we could have the potential to actually create a candle like this where we gap down, flush, and then come back up to end the week off. And the way I could see that happening is by actually jumping forward a little bit here on our schedule to just make sure it makes sense. We look at Wednesday. So Wednesday, we have the FOMC. We also have VIX expiration on Wednesday, and we got Jerome Powell speaking on Friday. So how we could potentially form this candle here by gapping down, pushing down, and then closing the week off strong would pretty much be related to the FOMC and then Jerome Powell speaking on Friday. So that is how I could see us forming a bull scenario. I don't know if that's going to happen. I also don't know if we're going to get a gap down. But when I look at what's happening to crypto right now, oh boy, it's looking a little bit ugly. Right now we have Bitcoin falling right another 2.3%, back below 29,000. And then notably ETH is down nearly double digits right now. It's at low 1500s, and it's lost all of its relative lows. So this is very ominous to me because this might be the start of the sell-off that we're going to have to create that gap down going into Monday. So that's notable to me because we had fresh selling coming in on Friday for the US index, and we have a gap on the chart. We got volume increasing, so that's likely going to lead to a feedback loop where we're going to see Asia and Europe also sell off. And that is how we could create that gap down pump up. So again, that is kind of a scenario I'm looking at here. Second scenario was that maybe instead we're looking at this period back to here, where if we're going to be forming a bottom, again, what do we have here? Well, let's now delete this, and we can note that we have the low, higher low, higher low. What do we got here? Low, higher low, higher low. But we're sitting at the low of the week here. So is that valid? Well, I don't know. I'm just trying to find out whether or not there actually is anything bullish left here. That's all I can really see. What I would note in terms of the bearishness is now going to be, again, deleting these two boxes. And we can note here that we had, again, we note that we were moving down. So stocks can do three things. They can move down, they can go sideways, or they can go up. So we have to be mindful of what the chart is actually doing. So for 7 weeks in a row, straight down, it started going sideways, started going back up because we had a low, higher low, higher low, high, higher high, higher high. Three candles would be considered a pattern for me. But then once we broke the range here, we had an inside bar for a large part of the week. And once we lost last week's low at 403.97, what happened? Oh, baby, we waterfalled, right? Dove down, gap down, and yikes, that is a huge decline here. So from roughly 407 to where we closed out, that was a lot of damage, right? We closed down nearly 4% or most of the losses for the week. If you zoom into the hourly chart, it's even more obvious here. Going into the Thursday close, we had a big hour sell, follow through selling, closing at the low. There's barely any wicks here. So we open up the hour, slam it, open up the next hour, slam it, open up the next day, slam it, go into the close, slam it. And this is interesting because, again, we've not really seen these sell-offs into the close like we had here for quite some time. We saw that on Thursday. There was follow-through on Friday morning. And then all day we built up pressure just to what? To give it all back and close at the low on Friday. So more selling into the close on Friday. This is very, very notable to me. So again, what I'm trying to just do is understand where we are technically before we try to decipher where the market could go from here. So what I do want to do now is actually take a step back and go and have a look here at our PowerPoint. Significantly shorter this week, so again, there should be a lot less for us to go through. I am going to give an update here on the psychology chart or the monthly chart for SPY, and I'm going to do that right now. So what's really important to me as we go forward here to our next part, you can note I already have 4 different boards prepared, which means there's a lot of notes for you. So if you're enjoying the video, I would really encourage you to watch all the way through and to please smash a thumbs up. I would really appreciate it. All right, we're also going to talk about options because just before I forget, again, we will circle back a little bit later in the show, maybe in about 10 minutes. We will talk about options. So what we want to do first is understand what is the chart telling us, and then what are the key areas, and then is there options motivation here? Because 3.2 trillion is an incredible amount of money to be expiring. We got 1.7 trillion on SPX. We got E-mini futures, non-SPY, SPY, pre-market for SPX, non-SPY ETFs, and then also single stocks. This is going to be a huge bonanza. And with the Fed also speaking this week, it's going to be notably important. So what I want to look at next year is actually going to be the psychology chart for SPY. And what I'm going to do instead here is actually defer to my notes. So my notes here are actually already prepared, and this should be fairly easy for us to go through. So as we were, again, this is what we were looking at going into the end of last month, where I was looking for the chart here, and we can note that, again, we have a megaphone pattern. What we can zoom in on here is going to be the green line and the green curl here. So we can note that we bounced off the same area. We're holding our funnel higher here, which is our pink line. And then as we zoom in, we formed a bottom to actually hold here. And if we go look now, oh, okay, so we actually closed above, and now we're revisiting. Yes, we are revisiting. So for this pattern to remain valid and for us to actually get that dead cat bounce and actually test 430, 440, maybe even 450, we cannot print a lower low. We've already penetrated the pink line once, and that was last month. So now that we're back below it, and for us that's roughly 400, if we lose this low, that's it. We have an inside bar breaking bearish. So this pattern is pretty much invalid. So it's very important what happens this week, because it's likely we're going to be moving big. I'm just not sure which way. So we already note that this is really important. If we lose that relative low or the yearly low, we're going to be getting a self-fulfilling prophecy. Second reason why is because if we note here, we're looking at complacency. Just have to cool off for the next big rally. That's what I've been hearing a lot of people saying for the last couple of weeks. And now we look at, again, if only 3% of people have actually sold or redeemed, it means that there's still 97 cents on the dollar that's stuck at 42.74, roughly 428 on SPY. And that is pretty much where we stalled out, right? We were not even really able to get above, right, 429.66 is our high. So at the first chance of getting their money back, people jumped. That's really notable to me. Now we have an updated chart here, and this is what it looks like. So now we can note that, right, we just looked at it before, but if we lose this low, it means that the pattern's been very reliable up until now, including the all-time high break, the head and shoulders, the coming back down to the uptrend, falling back below and above. But now, if we actually lose this low, it's pretty hard for me to say this pattern's still valid. We've already penetrated, and we did rally back up, and now we have a big puke. So this is really, really, really important for me in terms of where the market's going to go. So if we're going to keep cutting, it means that this is a trap for the bulls. The bulls might have a little bit of false hope, and they're going to get a big old smack. So that's pretty much where I want to start. Now let's look at the next thing. So now we know we have our pivots, and we also have supply and demand pockets. So now let's have a quick look at SPY and try to figure out exactly what that means. Then I have a few more patterns I want to look at here to try to tie the whole story together. So now, as we look here to SPY, and I've actually removed some of the noise here so that we can actually focus on what's important here. I'm going to add in the volume profile, and we're going to look at basically going back to 2020. So we're going to just zoom back a little bit in time, because I want to see what actually happened here from, again, pre-lockdown to roughly where we are now. So pre-lockdown to where we are now, we now have a volume profile, or this section over here which shows us what's going on. We note the last 3 weeks just butted up against this big pocket of supply, which is where the supply starts and aligns with our relative lows. We weren't really able to enter the supply zone. So for me, what that means is that people just wanted their money back. And then the bears were able to regroup, slam it right where we would expect at the relative low. And that does not really look all that great. So next thing I want to look at here is going to be the falling wedge pattern that we had here. So now we note that we have the supply and just finish off the story here. So if we hit the first level of resistance here and backed off, where do we actually land? Where the last big bar is, where there's the last big supply and demand pocket. If we lose this, again, and we go below the 281 we just looked at on the monthly, what does that mean? Well, it means that we're likely going to dead cat bounce and reject off the 380s and then go back down to the next supply pocket here, which is where? At negative 30. So once we get down to that negative 30, that is a test of the previous all-time high, and another bear market level gets tested. So if we cannot defend the 381 area, there's another notch for the bears here, potentially take us down to the 330s. On the flip side, if we're able to bounce off this area and gather up more steam, maybe we can finally enter the supply zone here, which is between 420s and 440s. So now that we understand that, what I want to do here is just get the rest of my lines back. And it looks like they're actually gone. So what I'm going to do instead is actually just restamp my line. And I believe 337 is the move off the all-time high. So here we got 480 times 0.7, which means we're going to have 336 is going to be our 30% off the high. So let's just do that together right now. Let's go settings, 336. There we go. Now we're going to copy this and make it negative 30 off the high. So the reason why this is important is because, again, if we're going to hit our next bear market target, if this starts to fulfill, meaning that we actually do lose 380s, I'm going to believe it. I'm not going to be like, oh, well, here's the reason why we're still bullish. We're going to have to believe what's in front of our eyes. So next thing to look at is just what's the pattern we have here, because we were looking at a bullish scenario, and now we note that we have our falling wedge. So I'm now going to, again, we have that same thing here. What I'm going to do instead is go over here to TC2000, which is a little bit cleaner for us to see. And we note that, again, we have our downtrend. It's not perfect either. I understand that. Again, we're looking for a pattern. We're not looking to recreate the Bible. So we note here that we have our falling wedge with the white lines. We ultimately come down to the period where we break out. So we break out of our wedge, which aligns with right here, our big candle breaking through 400. Where do we find resistance? Right here, buddy. Yep, right there. And where's the resistance? At roughly 415, 416, which aligns with our relative lows, going back here to March and then also roughly February. So the relative low is just all we were able to test. So what happens? Well, we get a move lower. So we break out of the channel, we hit resistance, again, bullish confirmed when we close above resistance, which we did, right? And now we're back testing here. Buy a retest of former resistance acting as new support. Acting as new support. So if it's acting as new support, where should we find support? Literally right here at 385. And it means that we have a very clear area to know that we're wrong if we go down into the 370s. So again, here we have the breakout, we have the back test, and if we curl, that is where we should start actually going back up. Additionally, what we also have here is an inverse head and shoulders pattern where we have a neckline, we have our head, and then we have another neckline. So that is how we can actually hit resistance, back off, complete the pattern, and now come back to where we are now. So let's have a look at this on the right-hand side. And again, it's not going to be perfect. So again, if you're like, oh, well, it's not perfect. So here we have, it's really small, right? So we have our shoulder, we have our head, and then we got our shoulder coming in right here. So all this means is that we have a clear area of support at the 380 area. And we already know if we're below 384, we're in bear market territory. So the bears already have the edge again. Dead cat bounce, back into bear market territory. All right, so that is the potential for us to again find the supply and demand pockets. If we start breaking down or breaking up, it's very notable. Easiest way for me to summarize this would be by just looking here again at the monthly chart and just understanding that we have an inside bar. So we fell back here to the pink pocket, which is where we were expecting to find resistance. And what happened? We did. We've got a full reversal candle here, but it's an inside bar because we're within the range of last week. One more thing I'll point out here is just by, again, looking at the daily chart. So once we lost this 407 area, like we noted before, it just started waterfalling. So once we fell back below 407, we put in basically 80% of the weekly declines happened within 2 hours on Thursday and then continuation on Friday. So if we do lose, if when we lost the weekly range, we puked fast and hard, what is the potential if you break the monthly chart? Well, we could go down sharp and fast. I'm talking nasty. So if we lose that 381, it could really start to accelerate. Why? Well, people who are long and they're going to admit they're wrong. People who are short are going to be shorting the breakdown. Just like you buy the breakout, you short the breakdown. So it's really, really, really important. We also have trapped volume here. Why? The biggest bars recently on the monthly are green. So this buying is now red. That's going to be terrible. All right, that is our supply and demand zones. We already talked about that. There's only been roughly 3 cents on the dollar that's been redeemed. So there's a lot of volume that is trapped, $1.1 trillion plus. And as we're seeing record tightening and quantitative tightening, it's going to be very interesting. And it was really interesting to note as well that quantitative tightening is not actually officially begun. It's going to be kicking off in January, but we're going to see the first reading of the Fed's balance sheet, I believe, on Wednesday. That's going to be very notable. All right, so now that we understand those areas, you're now going to note that we have some important support and resistance areas. And just before we do that, let's remind ourselves of the bear market targets. So again, 364 would be our 2021 high. 340s are now going to be, again, these are updated. They're going to be a little bit higher. So 340s gets us to the 200 weekly, the 50 monthly, and then pushing back down to 330s, we got that 336 or 30% off the high drop. And 339 is our 2020 all-time high. So the numbers are now becoming much more obvious. We're getting closer to, again, support in the bear market than not. But we can't really afford to stall out here. So what I want to try to do today, which is a little bit different from normal videos, is to actually explain the reasons why these are the support and resistance areas. We're going to spend a few minutes here. You've already noted the areas, but we got 387, which is again, the 27th weekly low. So now let's go over here to our chart, and we can just note that the first level of support here is going to be, actually this number's mixed up. Support 1 should be 387. I got dyslexia, I apologize. So 387 should be support 1, 385 should be support 2, and then 381 should be support 3. So just swap these two numbers out, 387, 381. So our first level of support is going to be 387, and that just comes from, oops, let me jump back. It comes from right here. So on the pattern we were looking at this one here. I was talking about how, again, I'm noticing that technically this pattern or the yellow box looks very similar to this one here. However, we could also be repeating the low, higher low, higher low. Why? Well, technically, we're still actually trending up. So if we can maintain this slight uptrend here, we don't go back below 386.96. That would be a higher low versus our big dead cat bounce week. So that's where this first number comes in. 385 is now going to be coming in from our low here at, again, the 9th. So here we got 38515, and that's going to be a very important area as well. That's 1 point above bear market territory, and it's also that inverse head and shoulders roughly that we're looking at here. So that's where we get this line right here from. That's pretty much the area we have to hold on to for our falling wedge pattern to be valid. And again, the falling wedge pattern is this one right here, where we're looking for that neckline to hold. So if we lose this area, this pattern is no longer valid, and we have to ignore it. We have to discount it. Last level of support is going to be 381. So that 381 is going to be the most important area because, as we noted, if we now look at a monthly chart, and we hide all the lines, if we fall, let's actually go to here so we make sure we actually have the story. It's this one here. So again, now we note that we have our massive megaphone here. If we fall below 381, it means lights out. It means that this pattern is invalid. There's more trapped volume, and we're probably going to be going lower. So again, if we lose the 380s, we have to be very mindful that it's likely going to start self-fulfilling. Now for resistance, we got 390, 395, and 400. These are mostly going to be options related and also round numbers. So now I'm going to jump forward to the next section here where we're going to look at SPX options because, as a reminder, there's $3.2 trillion expiring going into next week. All right, so next thing we're going to look at here is going to be the, we already looked at the psychology chart. We're going to look at OPEX, and there's actually one more pattern I want to look at before we do this so that I'm not bungling everything together. So in terms of the bull case, I'm also looking at two specific patterns here. So I'm looking at the daily chart versus the hourly chart. So what I'm looking at here is the pink box. I'm looking at this period in time, and then I'm comparing it to this period in time here on the hourly, where I'm noticing that the hourly chart might actually be providing us with some clues. So now we're going to look forward here and look at our, again, now we note that we have the two patterns here. So here we have the daily chart, and here we have the hourly chart. So I think what I want to actually do is open this in a new tab, snap this on the, go like this. So here's the one that we, let's go back to our daily, and now let's look at our one here on the left, and let's snap this here to be a little bit more over here. There we go. So now what I'm looking at here is we have the, let's actually move this over a little bit more. Let's just shrink it. Just trying to make sure it fits in the window correctly so we can compare them side by side, because that's what I'm trying to do here. So actually what I'll do first is just read the notes here. So we have a W, and it's, again, we have a W forming right here. So we have that W on the daily. On the hourly, we have that same W right here, which leads to number 1, 2, 3, 4. And then I have corresponding notes here. So number 1 is overshoot the 50 MA, right? Yep, W, overshoot the 50 MA. Number 2 is attempt to test the 50. So, right? And then we fall back below. We have a plunge. We come back up. We attempt to test the 50. Don't quite make it there. We now look over here at our hourly chart. It's really close. And the note here says that this big wick we have here is actually a dark pool print, which happened within a couple of seconds. So I'm kind of discounting that. So far we have the W, which leads to a break above the 50 MA, break above the 50 MA. We what? We flush. We have a gap down, and then we flush below, right? So we leg down after the 50. After we lose the 50, we leg down after a pause, come back down, attempt to test the 50, that gets us to number 2. All right, number 3, consolidation at or around the 50 MA. So now we have number 3 here, where we went sideways for, I think it was 8 or 9 sessions. That's a week and a half of trading. We look back over to here, number 3. 1, 2, 3, 4, 5, 6, 7. Interesting. Yes, it's interesting. Right here, we weren't quite able to make it to the 50. Here, we were, again, a little bit above, a little bit below, but roughly on the 50. So again, history does not repeat itself, but it rhymes. And so far, this is rhyming to me. So that's the consolidation at or around the 50. The number 4, we gap and waterfall off the 50 into an IHS neck. Now let's have a look here at number 4. Oh man, let's look in really close because this is looking awfully familiar. So number 3, right? We form that base, and then we what? we waterfall off the 50, which is exactly what we did here. We waterfall and then gap. Waterfall and then gap. But we what? Maintain the IHS neck, which is exactly what I am potentially looking for the bulls to maintain here, where we flirt with bear market territory again at 384, but do not quite break it. So again, the W leading to again, this was our wall of worry. So a win all over the wall of worry, and then what? Right back down to the 50, lose the 50 on a double slam, right? So slam it once, slam it twice, slam it once, slam it twice, post Powell, and then what? Dead cat bounce, flush it, dead cat bounce, flush it, reattempt to get to the 50, reattempt to get to the 50, artificial print, leg down, rallied all the way back up to form that base number 3, right? There's our number 3 base, and then shoot off it again. What do we have here? Again, we shoot off of it. Let me zoom in really close to see if you guys can see it here. So number 3 is the most important one for me, right? We form support on the 50, we plunge or waterfall, continuation, and then we bottom out. That could be very interesting. How could that happen, Justin? Well, this could happen if the selling that we had in America leads to only future selling, which means that by the time we open the cash market on Monday, Europe also has a chance to sell off, chooses not to, and then comes back up. So now let's try to explain what I just mentioned. The DAX also has these huge holes here. So the DAX is already down by 3% on Friday, which means maybe they gap down, pump up, and when we open the cash market in the US, the DAX could have already had its move down, and it is now roughly back at break even. So that means that the cash market in the US would be opening up roughly flat. That would be the bull case, where we don't have to actually go down anymore. All right, so that is what I was looking at here. And now the next thing to look at is just keeping in mind the support and resistance areas, notably 390 and notably 400. Now we're going to look at the options expiry for June 17th updated. And again, as a reminder, this is where we have $3.2 trillion expiring. So we can note we got $3.2 trillion expiring on June 17th. And now we're going to look through from the straddles from the screenshots that I made from June 6th. And I don't know why it's not jumping forward. Here we go. So just trust me that I'm going through and looking at these to try to identify whether the open interest is either increasing or decreasing, because with the biggest drop since January, I would have guessed that they would have been closing out some of these puts. They did not. They didn't close the puts out. It was very notable. So looking at 4,000, we got 90 on the call side, 110 on the put side. As we look forward to where we are now, 90,000. Again, these are shot this morning, roughly 2 hours ago. 90,000 on the call side, 106 on the put side. There's still volume there as well. So they're not closing out anything. No, they're not. They're keeping everything open. From 4,000 all the way to 4,200, it's almost the same. What I did note as being different is right here at 4,150, there's roughly an extra 10,000 added at 4,150 to go from 30s to 40s. And again, it's roughly the same open interest. So my takeaway here is that since the open interest isn't really reducing, and we have $3.2 trillion, but specifically 1.7 trillion on SPX, what this means is that we have to pay attention to the premium. So if the open interest is not reducing and the calls have been all but forgotten, what do we have to do? Well, we want to understand what are the levels where they get their money back, because I'm guessing they want their trillions of dollars back, right? Just like they took the supply that we had they took the liquidity that was available for the 428 area for the 1.1 trillion in inflows. I think the same thing's going to happen here. So we note that on the 4,000 straddle, as of right now, there's 150 points in premium. So when we look to the 4,000 straddle, we take the call side plus the put side. That's the premium total. And we know that we have to move 150 points, which means we have to be below 3850 or over 4150 for break even. For the 4,100, which we note right here with 40,000 on each side, we've got roughly $200 in premium on the put, and the call is worth about, $4, basically worthless. So what's it worth? About $200. Their break even is going to be at 3,900 or 4,300. And for the 4,200, which is this one right here, we note that there is $200, basically $300 in premium on the call side, and then cents, right? It's worth 85 cents on the call side. So what does that mean? 300 points in premium, or 3,900 for the put side payout, or 4,500 for break even. So this is really interesting because where is SPX closing right now? SPX at 3,900. Where? Exactly at 4,900. 3,900 and 85 cents, right? 3,90085. Interesting. Yes, this is interesting because we understand the motivation now. So when we look at the technical chart and we understand that these guys get their roughly $2 trillion back if we're at 3,900, I happen to think they're going to want more than their money back. So what can they do? They can slam it below 3,900 by next Friday and call in the puts and make some money. That's what I think is currently happening here because with the dramatic move we had down, they did not call anything in. They've been holding strong, so it's very notable. So again, that 3,900 area or 390 SPY is really, 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 really important. And then 3,850 is kind of if we lose this area, it's kind of a lights out. Finally, what I want to look at here is just going to be below 4,000. So because now we're a lot closer to 4,000 than we were last week, it mostly looks like put spreads beyond here. And also it appears like there is insurance for the payout sub 3,900. So what that means is, again, if there's trillions of dollars, which are now going to be making money below 3,900, they were out there making sure that if we do go lower, they're buying insurance. So I'm not noticing that we have as many calls as we do puts at 3,950. It's a little bit closer at 3,900, but this mostly looks like a put spread where we got 3,950 and 3,900. That's what it looks like to me. So what's interesting about that is it looks like this is them potentially trying to insure for avoiding payout below 3,900. So again, SPX is where the big boys are going to be playing. And I'll just note this here one more time because I think it's important for us to understand that we look at what premium is expiring, and SPX pre-market here is 135 billion. And then there's also 1.7 trillion. So SPX pre-market settlement is almost as big as SPY. So although we do often look a lot at SPY for the chain, it's obviously much more important for us to be looking at SPX because of the premium that's flowing there. And again, SPX is the actual index. SPY is an ETF managed by Spider. All right, so now let's look at SPY and just see whether or not there's anything that confirms or contradicts our thesis. So here we're looking at all the chains for next week because we're looking for the lead up into Friday. We also note the important dates with Jerome Powell coming out on Wednesday and then also speaking on Friday. What do we have here? Well, first thing that sticks out is that there's not very much open interest, right? There's a couple above 10, but not really all that many. There's also a lot more puts in terms of open interest than calls. There's not a single one here, which is large. Why? They've probably called them in or they're not trading it. So open interest is a little bit muted on both sides. And then in terms of the largest strike, here we have it at the put at 390. So that 390 put is right there. We also have 250 in premium, which means 28750 break even for Monday. And that 387 was one of our support and resistance areas. So if we go back to here, again, is it confirming the level that we have here? Yeah, that's our support one at 387. So that pretty much confirms what we were already thinking. And then right 385 is where the big puts stop. That's also our support too. Yep. So also important. We note that same note. And then on the call side, where are they trying to go after? 395. And they're really starting to get aggressive here at about 392. Why? Well, 392 plus about, right, roughly, we'll just call it $3 because I lost $8 in premium. 392 plus 3 is equal to what? 395. So that's what's important to me. We look at our resistance here. We got 390 options and round number, which we noted, and then 395, also a round number. Okay, so as we look forward here to Monday, the 13th, this kind of already confirms what we're looking at. Yes, it does. So SPY, not SPX, is kind of confirming what we already thought. And what I'm trying to do is provide a balanced approach for a bull and bear case because, frankly, I just want to understand what's happening. I'm not trying to make a big call one way or the other. I think there's a trap being set. I don't know which team's going to win. So what we can do is just be prepared for what if we're right, what if we're wrong, and where do we know we're wrong. So 393 is where it starts on Wednesday. This is going to be the FOMC day. A little bit at 390, a little bit at 385 volume, a little bit at 382 open interest. So what would this break even be? Well, this would be 380 break even. So that would pretty much get us to where? That would get us to our support 3, which would mean what? We're losing our monthly low. Why? 382 put with $2 in premium means 380 break even, or a new 2022 low. This is pretty muted here, but it's at 395 and we have 385 open interest. So this one here is much more muted, but also kind of confirms the same levels we're already looking at. All right, now the big one, which is going to be Friday, June 17th. Right, 395. I'm guessing they're buying up to 400. I'd be guessing that's part of a spread. We note that they're buying right from 390, kind of stopping at about 395. Not a lot of open interest over here, though. Oh boy. Right, 395 put, volume open interest, 392 put, volume open interest, 390, volume open interest. And then we got 385, volume open interest. It's going to go all the way down. I already know it's going to go all the way down. So what's important about this is that where did we close on Friday? Roughly 390. We closed at 389.8. So an at the money put for next Friday is worth how much? Man, it's pretty expensive. It's almost worth $7. So if this thing's worth $7, it means they get their money back where? At 383. They only get their money back. And 383 is like right between our support 2 and support 3. It's like kind of really important. There's also a follow through here. Again, 385 put is worth about $5. So where do they get their money back? At 380, which would be what? A new 2022 low. New low of the year. And then 382 also has activity here. So this also confirms that the bears are significantly more motivated to take us down. But what it also means is that if they're able to walk it above those areas, it means that they're going to be avoiding payout. Again, SPY is a significantly smaller amount than SPX. But if they want to avoid payout or burn premium, they have to take it above 390. We have to close the week out green. That's the biggest catalyst for me. We can start the week off red, but by Friday at the close, we need to be higher. Why? Look here. So after market settlement, $2 trillion. Aftermarket, pre-market settlement, it's going to be, again, we're looking at SPY, SPX, non-SPY ETFs, and then single stocks. So maybe that's post-market. I don't know, AM, PM. I don't know if that means in the morning and afternoon. I'm actually not even sure. But either way, there's tons of money expiring here. So now that we understand all that, I think it's really important for us to keep that in mind. Let's now look at our bear market targets, which we've already talked about. So we're just going to push forward. And then again, remembering that it's okay to be wrong. It's not okay to stay wrong, because if you stay wrong in this environment, again, we're only at about -20 on SPX right now. Going down to -30, you now have to almost make back twice as much as folding here and buying back to get your money back. You got to make 43 to get your money back versus the 25. So just be mindful that not every dip is equal, and buying the right dip with a proper risk reward is going to make sure that you're going to survive the trade another day. Probably the most important thing this week. Key dates, already talked about them. We got PPI, or Producer Price Index, coming in on Tuesday. Again, this is usually a leading indicator for inflation, and inflation has been absurdly high. Joe Biden is warning that, again, Biden warns that U.S. inflation could last for a while. And this is after meeting with Jerome Powell. So if Biden is now trying to do this, what was he doing before? I'll make a quick note here, right? He's been calling it a Putin tax, and he's also been trying to push the blame back to Powell. So the fact that now he is starting to embrace this and say that, yeah, well, it doesn't really matter whose fault it is. It just matters that there is real inflation, and it might be here for a while. So if we do get more, he's not going to look like a buffoon, because right now he kind of does, like where everyone's been saying transitory, blah, 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 blah. And I think people are getting really tired of it. It's hard to believe them. Why bull or bear? We've already gone through this so much. I'm just going to skip it for now because the base case is still intact. All right, let's go to the bull case. Already talked about the falling wedge breakout. It's pretty much right at the inflection point, or where we buy a back test of the former resistance. If this does not hold, it's lights out. The falling wedge is invalid, and we have to accept it. IWM and ARC bounces. So this is where the plot thickens a little bit. And I want to go back to my board over here, looking at IWM. And this is where I have most of my lines drawn. So if you remember, when we were looking at IWM a few weeks ago, I was looking at this to try to potentially be calling a bottom. And then where would resistance be? Well, again, what was resistance in 2018 and 2020 became support on this leg lower here. But where did we max out? We maxed out at the relative low. Same thing as SPY, by the way. So we maxed out here, and then we plunged 4.5%, engulfing the entire previous candle. It's not on volume, though, so that's also notable. So where we would expect to find resistance, we did, and ended up being a big pivot. We also cannot break the downtrend, so we're still stuck in a downtrend here, with a really big apex coming into end of August. Pretty much the same thing happened for ARC, although I did not quite make it up to its relative low here at about 51. It only made it to 47. Close enough, within 10%. I would say that's close enough. The Bears, right? The Bears definitely got a lot more arrows in their quivers in their whatever, right? Arrows in the quiver. I think that's what it's called. I mean, I can't talk today. Anyways, I want to talk about a few more things because I think the Fed's credibility is actually on the line here. So I think the Fed's credibility is on the line because as we look back to some FOMC prep that I did before, I just want to flip through a couple of things here to try to craft a narrative. So as we look here, we can note that core spending pressure year over year. A lot of it is going to be fuel. Some of it's going to be food at home, 10%, 11%, 12% on that one. 50% is big for fuel. Household furniture up by 9.7. Rent is up by 5.5. Apparel's up by 5. So I think rent is going to be where we're going to start seeing a lot more pressure. And the numbers from Friday were not very welcoming or encouraging. We can also note that the US has got the second highest inflation here. We note that the UK is at 9%. US is at 8.6, Euro's at 8.1, Germany at 7.9, but surprisingly, we look at Japan and China, they're at 2.5 and 2.1. Really, really, really interesting. Finally, when we look at this 8.6 figure here from inflation, you now have to look at where the Fed's dot plot was last time, because this pretty much tells us where they think they're going to have to go. So we can also note here that we have a FOMC dot plot median, which means where they think they're going to have to be. And by the end of this year, they think they're going to have to be at about 2.75. Okay, and then they're going to flatline there and then actually come back down to 2.5 in the longer term, meaning 2025. We can also note that the latest value here actually shows that we're actually expected to be at 2023, and then we're going to be down to, 3% by end of next year, and then, 3% this year, a little bit down next year, and then more down the following year. And this pretty much aligns with what Ray Dalio was talking about here. Ray Dalio says central banks to cut rates in 2024. Well, that's kind of what the Fed funds future is pricing in, where they're going to be front loading more of the Fed hikes and then potentially be easing into 2025, into the next couple of years, 2024, 2025. And again, cuts rates in 2024. That would mean that this Fed fund future is currently correct, and so is the blue line. So I think this is really interesting as well because, the market was also pricing in 200 basis points of ECB hikes by 2023, by May, in the next 12 months. And we've already done the work here, The work was that what is needed to get to neutral? Well, again, what was officially communicated from the Fed before was roughly 2.4%, and that's really close to the line we just looked at. But how do we actually get there? We got to go 50 in June, 50 in July. And again, there's also that asterisk there. So this is going to be a very important meeting. It's a meeting associated with some economic projections. Then we're expected to do, again, if we're going to get to 250 by the end of the year or neutral, we have to do 25, 25, 25. And I think that the discussion might now start to be around 50 or 75, not 50 or 25. They could also just go 50 at every meeting between now and end of the year to try to get them out of the way. And I think we have to pay really close attention to what Jerome says on Wednesday. But it's very, very notable to me that when I look at the dates here, again, it's not 100% confirmed he's actually going to be speaking on Friday. But why would this be scheduled? Is he a little bit worried that he might lose control of the narrative on Wednesday, and then he's got to be out there to massage the story on Friday? It's kind of what it seems like to me. It's kind of what it seems like. Something else I just want to point out here is that if we look at the Fed funds effective rate, or the FRED, right, what this pretty much tells me is that we have again, we're back to inflation not seen since 1981, and the interest rate in 1980s was a lot higher than now, went as high as nearly 20%. So, right, from 20 down to about 11, down to about 10, down to about 7, down to about 5, down to about 2.5, or high, lower high, lower high, lower high, lower high, lower high. We can also do our normal charting, our technical analysis on here and see what? There's a head and a shoulder with what? High, lower, so high, lower high, lower high, lower high, lower high, lower high. And with this Fed fund futures and what the Fed plot currently projects is that we're actually going to be at a higher high. So if we're going to be at 2.75 or at 3, what does that mean? It means that we're going into an era where we're actually going to be putting in a high and a higher high. I do not know if the market can legitimately handle this. So I think it's going to be very interesting in terms of what we actually hear from commentary. We're going to get an updated dot plot. I'll be paying close attention to that. Also paying attention to what Jerome Powell actually says during the Q&A. I was hoping today's video was going to be a little bit shorter, but there's just so much for us to get ready for going into next week. So now let's have a look at a couple of charts here, and let's start wrapping this up. Make sure there's nothing else I'm missing here. So bear case is pretty obvious, right? Let's get to these bears. Fed rhetoric, going to be very important. And the balance sheet runoff is already starting well ahead of the Fed actually talking. So paying close attention to that. Finally, we also have the recession-like behavior, which we noted before. So if the market's currently looking like it wants to go into recession, are we going to be able to avoid it and do it in 2024? Or is it going to happen a little bit sooner? I think it's also going to depend on what the Fed tells us. And then finally, if the bear market is in motion, we have got a pattern here, which tells us that, oh boy, this could be the big one. Could be the lost decade. All right, so I think we've done a great job of jam-packing it with value this week, trying to understand all the things we need to know for the week ahead. And now let's look at some charts. So what we're going to be looking at here are going to be weekly charts, and I'm actually probably just going to flip through these all one by one. And now that we understand where the market could be going if we're bullish and if we're bearish, are there any other clues that these other charts are flashing to us? IWM, well, I would say yes. Again, we have a big flush of volume here, but what I want to do instead is actually zoom out to a 12-month chart or a yearly chart, because here we can note that, oh man, this is not good. We note that we're now back below the 2021 low at 397 by about roughly 8-9 points here. So if we remain below 300, it means that we are in a lower low, with a lower high. We've almost engulfed the entire previous candle, and this is what a bear market looks like. So that 300 on QQQ and 400 on SPY are going to be even more important, especially after where we close this next week, meaning next Friday. We're basically almost all the way back into the falling wedge as well. So if this is a back test, we cannot really afford to do much else. We got to bounce off of here. We got to get out of this corrective wave. In terms of things that could be a thorn in the side of the market, we have the dollar. Fresh big push, up 2% on the week. SPY is down by 5% on the week, so nearly half the losses can be attributed to the dollar. We do have a golden cross. We do have a W, so the dollar looks like it wants to win. VIX, now starting to actually look a little bit more like a cup and handle, starting to form a handle, still only in 20s, so we have to get back into 30s to be at elevated volatility. TNX, new 52-week high, and definitely back inside the pocket. So if it's holding this area, just like the dollar, that is going to be adding pressure. Oil. Oil here, again, we still have a cup and handle, so it's still bullish, even with OPEC bringing more supply online. We got gold also pushing off of the 50 MA, closing the week up by 1.3%. With the dollar up, that is unusual. On the flip side here, what is crypto doing? Oh man, falling out of the demand pocket. So every previous time at 30 below 30, they would buy it, sell it. That's what it looks like so far. Losing the low here at about 25K on BTC is probably going to lead to even more downside. Crypto winter. Let me know what you think. Is crypto already in a winter? Is it going into winter? Or what are we going to do? Same thing here for ETH. So new yearly low, decisive break. We had, again, buying below 2, and now selling. It's actually accelerating down by 16% on the week. It's even lost its relative low going back to here at 1545 and putting in a fresh cut. So we're probably looking for about 1,300 next, right? That's pretty bleak. That's already the 200 weekly moving average. Starting to look a lot more like ARK. Now we're going to look at the trillion-dollar companies. Apple ended up getting a big rejection here. So at this pink pivot or the relative low, it got a rejection. It's stuck in the funnel, and if it's going to break bullish, it's going to, we're now in a falling wedge. If it's going to break bullish, it pretty much has to do it now. And if it's still our leader, it cannot afford to stall out. Looking at Microsoft, it's still in head and shoulders dominant pattern, trending down with this funnel here. So, right, until it stops going down, it's probably the path of least resistance. Google, very similar, although it did break its downtrend, looking a little bit like a V recovery or a inverse head and shoulders, but not looking great either. Amazon, right? Yuck. Right? It's gone. It's puked up 10%. Dramatic move. This is not looking good at all. So it's now had its split. It's right back to its relative high here. So it's either going to break down below 109 or break up above 120s. Watching close. Tesla, all things considered, actually holding up not so bad. Also announcing another 3-to-1 split. So the stock's going to be worth roughly, I think roughly 220 or the opposite of 420 if you do the math. Elon loves that number, so watching really close to our relative low here at about 700. If we're below 700, resistance. If we're above, support. Facebook is now officially Meta, and we can note here that fresh cut, so new name, same trend, down, right? Down. Thank you, Facebook. It's also got a bearish engulfing candle because it printed a higher high and a lower low, fully engulfed it. That is bad, right? Bearish engulfing candle is usually a very bad sign. Doesn't even have volume yet. And that goes back to the people are not really folding yet. Let's go to NVIDIA. Also breaking down, lower high, lower low, and no volume either. So just looks really interesting. Now jumping to these ETFs. Dow slammed, right? Obliterated. Really micro higher lows here. I don't know if it's going to hold on. Really low volume too, actually. XLK, perfect reject off a red line or what? The relative low. So what was support became resistance. IWM, again, what was support became resistance and also the downtrend. ARK, let's hide all the lines to see what's actually going on here. Bearish engulfing, right at the low of the week. Not nice for me. No big volume, though. NYA, I'm still stuck in its most recent megaphone here, right? So just riding lower. Bearish engulfing, so printed a higher high and right at the low of the week. Bearish engulfing, right at the low of the week. Fell out of the pocket as well. Not looking great. XLF, about to fall back into a demand pocket. Lower high, lower low, right at the low of the week. XLV, just barely hanging on to these lows here. Almost ready for new yearly lows as well. XLE, I don't know what's going to happen here. It's really strong. XLU, backtest of the previous all-time high to 2020, so very notable, right? We can see that dotted line coming right across here. So hit the all-time high, bounced off of it. Let's see what happens. Emerging markets, stinky. And then FXI, also stinky. So that is a lot of data for us to have gone through. So I hope that you got some value on this video. If you did, I would really personally appreciate a thumbs up and make sure to drop me a comment. I would really appreciate it. We read everyone and try to respond to everyone as well. Actually, last thing I'll just look at here, just before we sign off, is that we also have to keep in mind that individual stocks are now putting in big cuts across the board. And when we look at the year-to-date performance, everything's now back inside of bear market territory. Microsoft 24, Google 23, Apple 23. Right, let's just go non-sector for the biggest stocks here. Apple in bear market, Microsoft in bear market, Google in bear market, Amazon in bear market, Tesla in bear market, NVIDIA in bear market, JP Morgan in bear market. So there's not a lot of stocks which are actually strong pillars of support right now. So with that said, I'm going to Encourage you to watch the video that will come up here at the end of the stream, which is going to be for our bear market of 2022 explained. Otherwise, I wish you all the best of luck this week, and come back if you want to have us give you updates. We put out videos every single weekday. I look forward to seeing you on Monday. Thank you.